Feeling lost in the world of mutual fund categories? Let's unravel the mystery behind multi-cap, multi-asset, and flexi-cap funds. These funds are designed for different strategies. Let's dive into each option, uncover its strengths, see what makes them unique, and by the end you will know exactly which one fits your investment aspirations. Because let's face it, understanding these differences can be the difference between just investing your money and actually growing your wealth over the long term. So if you are ready to become a smarter investor, hit that like button and let's get started. Let's start with multi-cap fund. Diversification is key in the stock market. You don't want to put all your eggs in one basket. Multi-cap funds invest in companies of all sizes, large cap, mid cap, and small cap. SEBI mandates at least 25% in each segment. Remaining 25% can be allocated as per the fund manager's strategy. This balanced approach manages risk and offers growth potential. Ideal for investors seeking a balanced exposure across market capitalizations with potential for higher returns over the long term. Next up, we have multi-asset funds, which spread investments across different asset classes. Instead of just stocks, you are also investing in bonds, gold, and even real estate through REIT. This reduces risk by not having all your money in one place. If one asset class underperforms, others can cushion the fall. Multi-asset funds usually require a minimum of 10% allocation to each asset class. This makes them less risky compared to funds focused solely on equities. They are ideal for conservative to moderate investors who want diversified exposure across different asset classes in a single fund and lower volatility. Finally, let's talk about Flexi-cap funds, the dynamic approach. These funds are all about flexibility. Unlike multi-cap funds, which have a fixed allocation requirement for different market caps, Flexi-cap funds give the fund manager the freedom to invest across large cap, mid-cap, and small-cap stocks without any restrictions. This means the fund manager can dynamically adjust the portfolio based on market conditions and their view on which market cap segment offers the best potential for returns. Think of it like this. If the fund manager believes that small-cap stocks are poised for significant growth, they have the flexibility to allocate a larger portion of the fund towards that segment. On the other hand, if they feel that large cap stocks offer more stability during volatile times, they can adjust the portfolio accordingly. This flexibility and dynamic approach can be advantageous. But it also means that the risk level of a Flexicap fund can vary significantly depending on the fund manager's strategy and investment style. This fund is ideal for investors looking for flexibility and fund manager discretion to capitalize on opportunities across market capitalizations. Here's a comparison of these categories across key features. In terms of focus, multi-cap and flexi-cap funds focus on equity, while multi-asset funds diversify across asset classes. Regarding regulations, multi-cap and multi-asset funds have strict allocation rules, whereas flexi-cap funds offer complete freedom to the fund manager. Next, it's risks. Risk varies by fund type. Multi-cap funds are moderately risky, multi-asset funds are less risky, and flexi-cap funds depend on the manager's strategy. Diversification varies too. Multi-cap focuses on market caps, multi-asset spans asset classes, and flexi-cap allows flexibility. Fund managers' flexibility. Fund managers in flexi-cap funds enjoy maximum flexibility compared to their multi-cap and multi-asset counterparts. So there you have it, the breakdown of multi-cap, multi-asset, and flexi-cap mutual funds. Each one has its own unique characteristics and caters to different investor profiles. If you want balanced equity exposure across all market caps with defined diversification, go for multi-cap fund. If you are looking for lower risk through equities, debt, and alternative assets, multi-asset funds are a good bet. For aggressive growth potential with maximum flexibility for fund managers, Flexicap funds are the way to go. Remember, the best fund for your ultimately depends on your individual risk tolerance, investment goals, and time horizon. Make sure to do your research, compare different funds, and choose the one that aligns best with your financial plan. When choosing the right mutual fund, there are some additional points you should consider to align your investment with your unique financial situation. Do you already have significant investments in debt instruments such as fixed deposits or provident funds? These may already offer you the safety and fixed returns that debt-oriented funds provide. What about physical gold? Do you already own gold, perhaps in the form of jewelry or bullion? This could influence whether you need to add gold-related funds to your portfolio. Do you own land or property that generates rental income and offers asset appreciation? Real estate exposure could mean you already have a solid foundation in tangible assets. Finally, consider your preference for equity exposure. Are you comfortable with an equal allocation across large cap, mid cap, and small cap funds? Or do you prefer a different ratio based on your risk tolerance and investment goals? The answers to these questions are unique to you. They will guide your decision and help determine which mutual fund best fits your overall financial plan. Remember, the best investment strategy is one that suits your personal needs and goals. Take your time, assess your situation, and make informed choices. Excited to learn more? Watch the next video in this series. Remember, knowledge is power. The more you learn about managing your money, the more empowered you will be to achieve your financial dreams. Until next time, happy investing.